OG John AG here. Silver just reminded everyone why they call it the devil's metal. One day it rips 7% higher, the next day it gives a big piece of it back, and anyone trading without a plan is getting thrown straight off this roller coaster. On Monday, February 9th, silver prices exploded toward $83 per ounce, a 7% surge that blindsided a lot of short sellers and made it look like the silver moonshot might be back on. But by Tuesday, February 10th, the entire tone flipped. Silver dropped back below $82 as a stronger US dollar and a wave of institutional profit-taking slammed right into that rally. This is the pattern we need to talk about tonight. Rapid spikes, fast reversals. And a market that is being pushed around by both industrial demand and macro speculation at the same time. Before we go deep, quick reminder so you don't get scammed. I don't sell courses, I don't sell signals, I don't run any VIP Telegram or WhatsApp groups. I am only on YouTube, right here on John AG here, with me, OG John AG. If anyone else uses my name or face to try to sell you something, they're fake. Block them and move on. If you appreciate clear breakdowns that don't treat you like you're dumb, hit subscribe right now, tap like, and comment Rollercoaster so I know you're riding this silver madness with your eyes open. Let's unpack exactly what happened in this article. The 7% surge, the instant reversal, what's going on with miners, industrial users, the US dollar, and most importantly, whether the $80 floor survives and what it could mean for a run back toward $100. Segment 1, the 7% surge, how we got from panic to relief and back. The article calls this latest move the silver roller coaster for a reason. On Monday, silver ripped about 7% higher, shooting toward $83 per ounce. That move wasn't random. It started during the Tokyo trading session. The Nikkei 225 had a bout of early morning instability. Japanese institutional investors, historically heavy users of precious metals, started shifting capital out of equities and into silver. That rotation out of Asian stocks into hard assets created what the article calls a vacuum of sell-side liquidity. In simple terms, nobody wanted to sell at those levels, and big buy orders started slamming into thin order books. Once that happened, automated buy programs triggered as silver pushed through key technical resistance. Momentum systems piled in. By the time New York opened, the move was already on fire. The article's words, by the US Open, the momentum was unstoppable, driving the intraday peak to almost $83. That's classic silver behavior. Asia lights the fuse. Algorithmic trading amplifies the move. New York walks in and finds a market already mid-eruption. For anyone short without a plan, Monday was pain. Segment 2, the Tuesday hangover, back under $82, but on Tuesday, February 10th, the mood flipped. Silver retreated below $82, giving back a chunk of Monday's spike. What changed? Two big things. The US dollar index, DXY, rebounded. And when the dollar strengthens, dollar-priced commodities like silver usually feel pressure. There was a wave of institutional profit-taking. Funds that bought the panic or rode Monday's surge started locking in gains. At the same time, global equity markets stabilized. Tokyo saw a late-day recovery. Europe opened strong. When stocks suddenly look attractive again, some of that run-to-safety money leaves silver. The result, a rapid round trip, up hard, then instantly down off the highs. The article uses this move to highlight how sensitive silver is in this new regime. It's pulled higher by safe haven demand and industrial fear. It's yanked lower when risk appetite returns and the dollar firms. So if you feel like every move lately is violent and short-lived, you're not imagining it. That's exactly what the data shows. Segment 3. You can't understand this without January's silver moonshot. The article then zooms out and says, you cannot understand this February action without going back to the January silver moonshot. Just weeks ago, a combination of structural supply deficits and a massive institutional short squeeze sent silver to an all-time high of around $121 per ounce. Industrial buyers in solar and EVs panicked. They dumped just-in-time inventory models and rushed into just-in-case stockpiling. That panic bid on top of short covering launched silver vertically. Then came the crash. Silver sold off roughly 50% from those highs, brutally unwinding part of the moonshot. Eventually, the market found a rough floor near $75. From there, this week's 7% surge was the first big sign of life, a blast back toward the low 80s that looked like the beginning of a recovery leg. So when we talk about prices swinging between $83 and $82, it's not just random noise. We're sitting on top of a recent all-time high near $121, a 50% plus crash, a tentative floor near $75, and now a new battle zone in the low 80s. This is what a market looks like when it's trying to decide if January was a one-off blow-off or the first act of something much bigger. Segment 4, winners and losers, miners versus industrial users. Next, the article breaks down who's winning and who's getting hit in this environment. On the winner's side, at least on the big up days, First Majestic Silver AG, a high beta pure silver play, surged nearly 12% during Monday's move, but on Tuesday as silver faded, it gave back a big part of those gains. That's the curse of high beta. It goes up more and comes down harder. Pan American Silver, PAAS, also benefited from the rally. But because it has a more diversified base metals portfolio, its move was less explosive but more stable across that 48-hour window. The star performer in this whole 2026 silver saga, according to the article, is Wheaton Precious Metals, WPM. Why? WPM is a streaming company, not a traditional miner. It doesn't deal with the same operational headaches. Fuel inflation, labor cost spikes, on-site disruptions, with silver swinging between $80 and $120. Wheaton's high-margin streaming model lets it report record-breaking cash flows without the same cost explosions hitting the miners. Institutional funds that want silver exposure without direct operating risk have been flocking there. On the loser side, industrial names like First Solar, FSLR, are taking hits to their margins. Silver is a key component in photovoltaic cells. At these elevated price levels versus historical norms, every surge in silver squeezes their costs. So the volatility is creating a sharp divide. Miners and streamers can win big on the spikes, but miners also get punished on the dips. Industrial users get punished by both sustained high prices and violent swings that make planning almost impossible. Segment 5, the macro tug-of-war, dollar, stocks, and the new silver. The article frames Tuesday's drop below $82 as part of a global macro tug-of-war. On Tuesday, the US dollar index, DXY, strengthened. Classic headwind for silver. Risk appetite improved. Tokyo stabilized late in the session. European equities opened strong. When that happens, the run to safety into silver fades. The get me out of here bid in metal shuts off. Funds rotate back into risk assets, and silver catches profit taking. The article also highlights an important point. Silver is increasingly decoupling from gold. Gold is still behaving as a relatively steady store of value. Silver, on the other hand, has this dual identity. Industrial metal tied to the green energy transition. Volatile speculative vehicle for macro traders. On one side, we have a structural deficit. Annual mining output is not enough to meet growing green demand. On the other side, we have short-term traders, algos, and funds using silver as a macro lever. That's why the article says every dip is met by value hunters. Every spike is met by profit takers. Put that together, and you get exactly what they describe, a high-frequency trading environment that is not for the faint of heart. Segment 6. The $80 line and the path to $100. Now, the big question, what next? The article says the market is bracing for more margin call volatility. Why? Exchanges like COMEX are raising margin requirements to account for these 7% daily swings. Higher margin means smaller leverage players get forced to reduce positions. Weak hands are pushed out. Positioning gets cleaned up, but price swings can intensify during the process. In the short term, traders are laser focused on one level, $80 per ounce. The logic is simple. If silver can hold $80 as a support floor, the article says a retest of the $100 psychological barrier is absolutely on the table before the end of Q1. So the near-term map is, above $80, the bull case toward $100 stays alive. Lose $80, you open the door to deeper corrective legs. They also mention that mining companies may need to hedge more aggressively. Lock in historically high prices, even if that caps upside. That's a classic late cycle move. Producers hedge into strength, speculators fight over the rest. For investors, the key challenge is distinguishing between noise, like a one-day dollar-driven pullback, and signal, like industrial buyers coming back to rebuild inventory or a genuine structural change in policy and supply. The article warns that the potential for a secondary short squeeze remains high if industrial users return to the market to replenish stockpiles depleted in January. Segment 7, the new reality for silver. In one of the most important sections, the article calls this the new era for silver. Key points: the days of $20 or $30 silver look like a relic. We're in a high-stakes environment where double-digit percentage moves can happen in a single session. The $121 peak was speculative excess, yes, but the underlying industrial demand from solar and EVs acts like a gravitational pull keeping prices elevated above old norms. In other words, the spike was emotional, the floor is structural. Going forward, the article says investors should closely watch the US dollar's trajectory, the health of the Tokyo stock market. Why Tokyo? Because this last surge literally started with Nikkei instability and Japanese rotation into silver. Asia is increasingly where the opening shot in silver is fired. Their conclusion? The silver roller coaster is far from over. Tuesday's dip is just one swing in a much bigger 2026 story. Segment 8. What this means for you. So what do you do with this? If you're a trader, understand that this is not a quiet, mean reverting market. You're dealing with 7% daily moves, rising margin requirements, algos firing on both breakouts and breakdowns. If you're overleveraged, this environment will force you out, not gently tap you on the shoulder. If you're a long-term silver believer, recognize that. Old price anchors like $20, $30 may no longer define the range. Structural demand makes sustained deep crashes harder, but volatility higher. Your job is to know your time frame, build positions thoughtfully, avoid being shaken out emotionally by every $3 swing. And for content and education, a move like this lets us connect. The micro, a 7% move between $83 and $80, with the macro, structural deficits, green demand, global rotation, and a new era of high volatility silver. Segment 9, in-video call to action for your channel. Now, if you're watching this and you want someone to walk you through these moves in plain English without selling you anything, this is the channel for you. You're on John AG here. I'm OG John AG. If this breakdown helped you understand why silver ripped on Monday, why it dropped on Tuesday, and why $80 and $100 now matter more than ever, then hit subscribe right now. Smash like so more serious people see this. Comment $100 before Q2 if you think silver taps 3 figures again before the end of March. Or tell me your own target and timeline. Your comments help me see what matters to you and what we should deep dive on next. Segment 10, 3 key takeaways, and we're out. Let's wrap this up with 3 key takeaways from this article. Number 1, silver just delivered a classic roller coaster move, a 7% surge toward $83 on February 9th, driven by Tokyo instability, Asian rotation into hard assets, and algo buying through resistance, followed by a drop back below $82 on February 10th, as the dollar strengthened and institutions took profits. This is not random noise. It's how a hypersensitive market behaves in a structurally tight, speculative environment. Number 2, the winners and losers are splitting into clear camps. High beta miners like First Majestic, AG, and Pan American, PAAS, are whipsawing with price, while Wheaton Precious Metals, WPM, is printing record cash flows thanks to its streaming model. On the other side, industrial users like First Solar, FSLR, are feeling margin pain as silver stays expensive and volatile. Silver is no longer just poor man's gold. It's an industrial bottleneck and a macro lever at the same time. Number 3, the article calls this a new era for silver. Old price zones like $20, $30 are likely gone. $80 is now a critical line traders are watching as a potential floor. If that holds, a retest of $100 before the end of Q1 is absolutely in play. Structural deficits, green energy demand, and the potential for another short squeeze all support a higher volatility, higher price regime. Do your own due diligence. Understand that a 7% daily move in silver is not a bug anymore. It's becoming the feature of this new market. I'm OG John AG. This is John AG here on YouTube. If you want more deep dives on silver's roller coaster, hit subscribe, drop a comment with where you're watching from and your silver target for 2026, and share this with someone who's still trading like it's a $20 silver world. Time will tell whether $80 holds and $100 comes fast, but we're going to track every step of that journey right here.